Hello and welcome to Options Guide TV. My name is Brian Overby, and I am the author of the Options Playbook, and I'm going to be your host for about the next 15 minutes here. This is going to be an Education Monday. We got a market holiday today, so we are going to record a show that is covering a trade that I got a lot of interest on. I got a lot of questions from the audience about, not only during the show, but also after the show. And it deals with a different way to do a covered call. So I want to set up the scenario here for you in that NVIDIA, which almost everybody knows what company that is, received some news, well, not necessarily about the company, but what came out was a new AI website that was done very cheaply over in China, and it was called DeepSeek. And that news was perceived as a negative on NVIDIA, and the stock dropped precipitously in that the news basically meant that DeepSeek was able to do what no one else has done for a lot less money and a lot less chip power from the semiconductor industry. So NVIDIA stock tumbled down, being a little bit, pricey as it was. And we came into Options Guide TV and just talked about ways to hedge NVIDIA, talked about a protective put, we talked about a collar, talked about a covered call. But we finished with the one trade that is playing out and that I want to discuss that a lot of people don't know very well. And I'm calling it a covered call on steroids. So we're going to start by running to the chart on NVIDIA. I put a little slideshow together, and I'm taking the numbers from the actual show, and I'm going to talk about it. So here's what happened with NVIDIA. And I have highlighted the date of the show on the chart. And we saw that the stock, basically ran down from the 140 level all the way down to the low was right around 112, but it wasn't there for very long. The day that we did the show, which was I think it was a Monday, it was on the 29th of January. And then you see what has happened with the stock since then. It was quickly determined that people are still going to buy the NVIDIA chips, and wasn't that long after that had earnings from some big companies that were mentioning big spends in the AI space, and their stock went down and NVIDIA went up. And so now we see the stock trading right at 137.48, and today is the expiration date on the trade that we did, which is the 14th of February, and that's when we're taping the show. So it goes hand in hand. So it's a good review of an interesting strategy, and that's what we're doing for Education Monday while the markets are closed for President's Day. So here we go. You own 100 shares of NVIDIA. The trade doesn't work unless you own 100 shares of NVIDIA. So the big assumption here is that you bought NVIDIA well before the downturn. The market did get hurt by the downturn. There were a couple other ways to hedge, but this is the way that I chose to hedge NVIDIA in my own account. So IV was 55%, which was jumped up and spiked. And that's important because it allows you to go wider on the spread that I'm going to introduce. The more implied volatility that you have, the easier it is to get this type of trade done for a decent net credit to the account. Now, first off, if you were looking at this and you owned 100 shares of NVIDIA, the first thing we'd probably look to do is sell one of the February 14th 137 strike call. Now that was trading for $1.50 on that day. So the stock's down, and envision that we're trading down around let's jump back and look at it. Right around on this day, we were probably 122. Yeah, 122, I think is where we were at. And you're selling the 137 strike out on the February 14th expiration. You're getting $1.50 for it. So one of the things that I don't want to do on a covered call is I don't want it to come roaring back and get pegged at a lower price. We're looking for a dead cat bounce in this underlying stock. Stock was up around 140 when the news hit and the stock started to tank precipitously to the downside. And that's kind of where I'm thinking. I'm thinking if this news turns out to be bunk, or not as important as everybody seems to think that it is, because fundamentally nothing happened in NVIDIA. It was just determined that there was a cheaper way to do AI than buy all of the NVIDIA chips on the planet. That's basically what was perceived from reading that article. So I want to sell something that's close to where the stock was at. So if I were to sell something, I would probably sell the 137 or the 140. Now, if you do that, obviously you sell the 137, you're going to bring in $1.50. Here's what my proposal is on the covered calls on steroids. We're going to sell 2 of them, but then that leaves us naked one because we only own 100 shares. Well, then we're going to buy another call. So we're going to buy the 131 strike call. That was trading for $2.54. All right. So long 1, short 2. Are we still covered? Right? We're long 1, short 2. Are we still covered? Answer is yes. We own 100 shares of NVIDIA. So that changes everything on this trade. This trade is referred to as a front spread. And I'm going to go right now to screenshots of my book, The Options Playbook. And we're going to look at what a front spread with calls looks like. So if you just buy a call at strike A and sell 2 calls at strike B, this profit and loss graph is showing that you have unlimited risk if it blows through strike B and keeps going on up. But we own the stock. So we're long 1 call, we're short 2. So this is the way the graph looks. And what owning the stock means is that we're going to take that nose and we're going to lift it up. And we're just going to cap our upside. We won't have unlimited risk because the 100 shares of stock that we own is going to protect us. So I'm going to jump back to the trade real quick. Like if you own 100 shares of NVIDIA, the implied volatility was right around 55%. We're going to buy one of the February 14th 131 strike calls, and then we're going to sell 2 of the 137 strike calls. So 2 means that this would be basically $3, right? It's going to be double 150 or $3 minus the cost of this call option, $2.54. That means we get this whole thing done for a net credit to the account of 46 cents. It's not $1.50. It's 46 cents, which means that if the market goes down, it doesn't give you as much of protection as the covered call. But if you do feel like I did on that day, that it was a little bit overblown and I expect the dead cat to bounce if you dropped it off the roof at least a little bit, and still bullish on NVIDIA. That's really what your outlook has to be. And you put this trade on now from 131 to 137, things can pan out. And basically from 131 to 137, you're like owning NVIDIA on margin. It's like you're owning 200 shares of stock as opposed to 100 shares of stock. And we saw the stock actually go out on February 14th. It looks like it's going to be very close to 137, which it never works out that well. I mean, I kind of feel guilty showing a trade that the market did exactly what you wanted it to do. Had no idea that it could come, or anticipated that it could come back to the 137 level, but I didn't anticipate that it would stop right at 137 right on the expiration date, because that's the ideal scenario. We don't want to get pegged. We don't want to sell our shares. We don't want it to run to 140. This call option would be doing better, but we'd have to give up any gains on the call option from 137 on up because we're short a call option. And also we may get our stocks taken away. So I guess I bring this up too, because if this position is on, you need to close it. You don't want to get exercised and buy another 100 shares of NVIDIA, and you don't want to get assigned and give up your NVIDIA. So here are the graphics. This is it from the playbook, and this is the graphic from the show. So here's the trade showing that, highlighting that I grabbed a screen grab, and this is the Tradier Pro software, 46 cent net credit to the account. Buy one of the 131 February 14th strike call, sell 2 of this expiration, same expiration, 137 strike call. You put it on without the stock, it looks like this. And then I'm going to go to the next screenshot, and boom, we add the stock. And now, like I said, that graph goes like this up to this because the 100 shares covers the other call. But here's our risk here. We have an opportunity risk from 137 on up. We don't benefit anymore. We could lose our stock is a better way to say it. And if you don't want to lose your stock, then you need to do something. You need to close this trade out before. And on the way down, our line isn't quite as, notice here, the rise or overrun is 1 to 2. So every time it goes up 1, we make 2. Goes up 1, we make 2. Goes up 1, we make 2. On the way down, we just get a small pillow to land on, only 46 cents versus $1.50 if we sold that 137 call outright. But interesting scenario. I don't want the cheese anymore. Let me out of the trap. I think there's going to be a snapback in NVIDIA. Here's a way to trade it. And it works well when a stock has made a strong move to the downside, because it increases the implied volatility in options across the board, making it more feasible to sell 2 and buy 1 and get it done for a net credit to the account. Thanks for tuning in to Options Guy TV. We'll be back this Wednesday for another live edition of Options Guy TV at 11 a.m. Eastern Time. Come and see me in the hub, hub.tradier.com. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.